Greetings, Algo Artisan. ECB cut rates. How is this going to affect markets? We're going to take a look at that. We're going to start with the news right now. Okay, so Zero Hedge article says here, ECB cut rates for the first time since 2019, does not pre-commit to a particular rate path. So when it comes to rate cutting, there are a lot of people who assume that cutting the rates means that the markets will go up. And we're going to take a look at market history to determine if that is the case. Now, it is the case, but maybe there are a few caveats. We'll get into those very shortly here. The point here, at least in this article, is that the ECB cut rates by 25 basis points. And they even mention here that it's the second G7 country to do so in as many days. First had the Bank of Canada cut, believe that was yesterday, and now you have the ECB, the European Central Bank, cutting 25%. Now what they've done is they have also increased their target inflation to 2%. So at the same time as they're cutting rates, they're also apparently raising their target inflation rate to where they can allow for more inflation in the future. Now they might hold the rates higher for a little bit longer to try and compress the economy a little bit, which would stop inflation, or at least it would temper inflation. But the fact they've raised their rates according to this chart means that they're willing to let it run a little hotter than they used to. It's kind of an admission that inflation is here to stay and on the long term is rising. And of course, we know that a lot of the inflation numbers are not exactly precise. Well, we can even say they're a little bit fudged, right? They have to make the numbers look like whatever they make it look like. So interestingly enough, it says here, bottom line, no surprises with ECB cutting rates as expected and remaining murky on the future. But the take-home message is clear. Any 2% inflation target the central bank may have had is dead. We just talked about that here. The market reaction was generally as expected, with the lack of dovish guidance lifting the euro from $1.08 to $1.09 over the course of 10 minutes. Yeah, definitely. That's basically they cut rates and they didn't say anything else, right? So dovish guidance means that they're talking about cutting rates again in the future. And it might have been that the market expected them to cut rates and say, hey, we're going to continue to cut for a while. But they didn't do that. They just simply cut rates. So whether or not they're going to cut them again is a question. And there are times in history where rates have been cut or at least paused and then either not cut right away or even lifted. And we'll take a look at history, at least with the Fed funds rate, very shortly. And mind you, the G7 banks are all going to be pretty much in lockstep. You're going to see them cutting and hiking in relation to each other. So let's take a look at the history of what's gone on with the Fed funds rate and what happens when it gets cut. Now, this is a 6-month chart. I wanted to see a lot of history here. I wanted to go back pretty far. And what you can see here is that, let's just go all the way back to 1968. And on this 1968, I'm going to drop it to the monthly. I'm going to use the calendar to go to 1968. So we do have an initial rate cut, and then it actually got hiked up a little bit more. They held it higher for longer. But what you'll notice is that prior to the cutting cycle, price started to fall. And this is the Dow Jones Industrial Average. So if we continue to look at further rate cut cycles, we had here in 1973, we had the rate cut for a few months, a couple of different cuts here, and then it got hiked back up. But before the cutting cycle happened, the market started to fall. And as the cutting cycle continued, the market continued to fall. And the market did not come up until the cutting cycle was done. And this lasted for about a year, a little bit longer. And it wasn't until it started to bottom out that the market started to pick up. And you see it again here. There was a bit of a cutting cycle and the market was falling during that cycle, especially right here. You can see where the rate was cut back and forth a couple of times and the markets continued to fall until rates got pretty low and then the market started to pop back up again. Next cutting cycle was right here on a higher time frame and the markets took a tumble, but this time they actually continued up, and this was in 1989. There were some pretty scary times in 1989, certainly when it came to markets. We had a bit of a recession at the time, but that ended up picking up through the 90s, and now we're looking at cutting cycle that happened around 2000. Each one of the major cutting cycles occurred with some type of economic issue, right? And in this case, this was the dot-com boom bust. And around that time, they started cutting November of 2000, and the cutting didn't stop until April of 2004. The market continued to fall from the beginning of the cuts, basically, all the way until September of 2002. The Dow just continued to fall. And then finally, when the rates started to get near the bottom, when they started to kind of hold them a little steady, volatility, people started to get back into the market. And we got the same thing right here in 2007 and 8, the great financial crisis. In July of 07, they started cutting rates, and this was rather steep. And they cut until January of 09, so almost a couple of years. And from October of 07, so not too long after, say half a year later, a little bit more, the market started to fall, and it fell from October, November of 07, and it continued to fall until February of 09. And it did not come back up until the rates were basically zero. They were sitting at 0.1%. And then the market really started to go up because money was basically for point. You see another cutting cycle, you see another market crash. This would be the Dow going from 29,000 to 18,000, and that happened just in the space of a few months. So every cutting cycle that lasts for any amount of time sees the market fall before it rises. So if they start to cut the rates, there's a good chance the market is going to fall. Now, there are rumors the Fed will possibly push cuts to July and not June, and who knows what will happen. We really don't know the future. It might be that we just see kind of a short-term cut just to stimulate a little bit, and then maybe rates go back up. I mean, it's hard to say. However, we do think that the rates will start to get cut. Even though there is crippling inflation across the board, they just can't help stimulate. It's just going to go and be what it is. We're going to see stagflation. That's the most likely scenario. Don't think for a minute that if these cuts happen and you see an extended cut down, that the markets won't follow for at least several months. That can happen. Now, what has me thinking that they may not start aggressively cutting is because we have an election and the incumbents do not want to see the markets fall. And the incumbents have a lot of control over what's going on in them. So how does this affect everything? Well, when you see the cuts happen, and the cuts are repeated cuts, and it's an aggressive cut, let's just say the Fed cuts rates in July and they say we're going to continue to do so. If they say that, then yeah, markets are probably going to fall for a period of time until the guidance is that there won't be any more cuts. How does that affect risk on assets? Well, let's take a look. Right now, you can see how it affects the Dow Jones, but we don't have a lot of history for things like Bitcoin. But we will take a look at gold. That might give us a little clue there. Of course, this does make some sense. Now, gold's pretty much been going up since about 2000, but there is a bit of what appears to be some bit of correlation here, where at least in the past, gold seemed to follow along with those cuts. And it might be that because the cuts eventually are there to stimulate the risk on assets, that gold might be sold in anticipation of risk assets being the thing to buy, because a lot of people might have to sell gold holdings, or at least interest in gold will go away as people become more interested in the stock market. But the real question is what might happen in Bitcoin, because we don't have a lot of history as to how Bitcoin reacts to these kind of monetary policy actions. From what I can see, there's not really a lot of effect. This Bitcoin cycle just seems to continue to move on its own, despite what's going on with Fed. And that might be an indication of basically a high time frame, long-term view that Bitcoin is an inflation defender, or Bitcoin's price is an indication of inflation, money flowing into Bitcoin because it's deflationary, right? So it may be that over a high time frame, these things are not going to affect Bitcoin. We do have where Bitcoin did fall around the same time as some rate cuts for this period right here. So it could be that in the short term, if there is an aggressive cutting of rates, Bitcoin could follow merely because the entire market starts to fall and people are selling all of their positions in everything, because we saw that in 2020 during the COVID crash when the rates really started to cut. And at the steepest time of cuts, Bitcoin and everything else started to dip. Now, of course, the cutting cycle began in July of 2019, so it's not to say the cutting cycle began because of COVID, although some people argue on the conspiracy side that they knew COVID was coming and went ahead and started the process before. I don't know about any of that. But you do see where the aggressive cutting happened. Bitcoin did take a stumble, so it might put some downward pressure on Bitcoin. However, we do have a whole new world of Bitcoin with a lot of money entering the market, and it may very well be that Bitcoin simply ignores that. So let's go ahead and end this conversation with what Bitcoin is doing right now. I'm going to bring on what's called the Wyckoff. I'm going to look at a different chart of Bitcoin first. We'll look at a cleaner chart here, and I want to diagram something out that indicates Bitcoin is actually getting ready to head up. This is called the Wyckoff pattern. And you can see here that if I expand this, that the Wyckoff pattern really seems to be what Bitcoin has been doing. And this is a typical sort of accumulation scenario where Bitcoin is accumulating. It can also be a distribution pattern as well. If price is to head down, it can do that. But in this case, looks to be a continuation to the upside. And this really is following along. I mean, it really matches up. You take a look here, price heads down, pops up for the AR, down to the ST. In this case, we didn't get that second test of the high, but price did head down. It did test a little bit of the upper area, right? And again, in the diagram down here, it doesn't break the high. It goes lower than the AR, so this is just a little bit lower of a move here. And then we have this low, which is the spring, and then we have price gathering steam, and then consolidating towards the top pattern. And this really matches up, so there is a pretty good indication here that Bitcoin is getting ready to head up. Now, whether it heads up right now or it heads up a bit later, that's going to be a different story, but we can take a look at some liquidity to see what Bitcoin might do next. And here's the Kingfisher. We have some liquidity pretty strong between 68.8, so basically 69,000 and 70,200. So right below price right here. The fact that most liquidity is close by price kind of tells us that price probably won't go too far, but that price will probably dip down to this area before it is done with its current dip. And there are some other items we could do to see if we can refine this. And now price might be actually attracted to about 69,000, almost on the dot there, because there is a lot of liquidity from prior price action. However, right now, according to the liquidity chart, it's right here in this box. So I do expect price to head down and grab that, and what happens after that is going to be demonstrated in the algorithms. It does seem that price was not ready to break out, and so it might be continuing to play in this range up here. And if it does get to the bottom of this range, I will long that. I will long that. As long as the algos are not terribly bearish, I will go ahead and do a long. And as a matter of fact, I'm going to put a note here at about 67,800. I'm going to start looking for longs. Ideally, it will be more towards the bottom of the range, but I'll take a look at price action at that time and continue to monitor. So it wouldn't surprise me one bit to see price head down to about 66,800. A lot of people do think there will be one last shakeout before the move up, but I'm looking at Wyckoff, I'm looking at the algos, everything's pretty bullish altogether, so my thesis still remains that price is going to consolidate below the top of this range, just like it does in the Wyckoff model, and head up after that. I hope this video was helpful. Please come to algofactory.tech. We help people build a trading plan, trading methodology, and they're mostly trading manually. You do have some people who are coding their algorithms, but most people trade manually. They trade their algorithms just like anybody would trade, so you don't have to know how to computer code or anything like that. And we have people who are already successful. Let's hear from one of those successful people right now.
Hey, Cowboy V. I just wanted to give a heartfelt thanks for putting this project together. I initially joined Algo Factory a year ago, concerned about a repeat of the 2008 Great Financial Crisis and the prospect of losing my job again. Within 12 months, under V and Cowboy's expert tuition, including live reviews, I've created a profitable algorithm launched across a selection of assets. Now, facing the prospect of redundancy and a nice fat severance package to trade with, my current worst case scenario is to keep my job. Thanks again, guys. Really appreciate what you've done here.
All right, thanks for listening to that. Don't forget, algofactory.tech, trade your job, upgrade your life. We'll see you on the next one.